Howdy, I'm Sean Pruitt, president of Kingdom Exploration. In the next few minutes, I'm going to reveal why oil prices could double or even triple within 18 months, despite every major bank calling for a crash to $52 a barrel. I'll show you 8 times since 1973 when this exact pattern created gains of 100% to 700%. I'll expose what's happening right now with Russian refineries being destroyed, Venezuelan tensions escalating, and why OPEC just said the world needs 18.2 trillion in new oil investment. And I'll explain why the smartest money in oil is moving in while everyone else is running scared. This isn't speculation. This is documented history about to repeat itself. Let's begin. Here's what happens every single time. When pessimism peaks and analysts declare permanent oversupply, something ignites a massive surge. Not a small bounce, I'm talking 100% to 700% gains. Right now, Brent crude sits in the low 60s, down 17% year to date. The IEA warns of a 4 million barrel per day surplus by 2026. Reuters predicts further declines. The EIA forecasts Brent hitting the low 50s. Bloomberg notes we are heading for a third straight weekly decline. Sound familiar? It should, because this exact setup has preceded every major oil rally for 5 decades. Let me walk you through the history. In 1973, a foreign policy journal called the energy crisis total fiction. Then the Yom Kippur War hit. The Arab embargo cut supply 7.5%. Oil surged over 688%. In 1986, the CIA forecast prices would fall over 40% due to unresponsive demand. What happened? Asian economic miracles and the Gulf War resulted in 534% surge to 2008. In 1993, the LA Times declared prices stuck low with little prospect of change. Asian industrialization proved them wrong. Oil climbed 446%. In 1998, The Economist ran the story, Drowning in Oil, predicting a 50% drop in permanent low prices. OPEC cut production, Asia rebounded, oil explodes 668% higher. In 2001, after 9/11, Merrill Lynch analyst Sue Graham said there was a glut OPEC couldn't fix. The Iraq invasion and the Venezuelan strikes followed. Oil rallied 298%. 2009, during the financial crisis, Merrill Lynch cut forecasts by 30%. Some predicted a 70% further drop. Global stimulus and the Arab Spring sent oil prices up 71%. In 2016, Goldman Sachs announced the new oil order. The World Bank chanted lower for longer. Analyst Austin Burston proclaimed the high price party's over for years. OPEC Plus discipline and Venezuelan collapse triggered a 141% surge. In 2020, when oil went briefly negative, Brookings forecast lows for the next 20 years. ANZ warned of a 70% downside risk. The Russia-Ukraine war and vaccine rollouts drove a 171% rally. Now, here's what's happening today that the mainstream analysts are missing. Just this week, October 11th through 17th, Ukrainian drones hammered Russian infrastructure. 4 refineries, including Saratov, 2 depots with 16 tanks ablaze, multiple pipeline substations. The recent strikes alone cut 10 to 20% of Russian refining capacity. That's 500,000 to 1.5 million barrels per day. Since August, cumulative strikes have disrupted operations at facilities representing 40% of total capacity. Russia's retaliating hard. Barrages on Ukrainian gas facilities cutting output 50%. 300 drones and 37 missiles in a single attack. Blackouts across 9 regions. There are credible rumors of escalations that could cripple Ukraine's entire grid by 2036. or potentially involve NATO. We've got 10% of the U.S. Navy deployed to the Caribbean. B-52 bombers are flying off Venezuela's coast. There's a $50 million bounty on Maduro for narco-terrorism. This connects directly to Iran and the Strait of Hormuz, where 20% of global oil flows. Putin himself has said he expects oil prices could reach $100 per barrel amid these sanctions and disruptions. When the Russian president starts talking triple-digit oil, supply situation is tightening. We are in week 3 of the shutdown that started October 1st. Over 700,000 federal workers furloughed. Once this resolves and Trump's policies kick in, 10 to 50% tariffs driving manufacturing back to America, we're looking at massive industrial energy demand. Now, here's what nobody's talking about. Just this week, OPEC Secretary General Haitham Al-Ghas announced world needs $18.2 trillion in oil industry investment through 2050. That's not a typo, $18.2 trillion. Why? Because even the International Energy Agency, the same IEA, calling for oversupply, just admitted we need to develop new oil and gas resources just to keep output flat. This is a complete reversal from their 2021 no new investment narrative. Think about this paradox. If prices stay low long-term, like the bears predict, who's investing that $18.2 trillion? Nobody. And here's the kicker. Even if everything I'm saying is wrong, and for the first time in history, the negative narrative actually happens, what do you think happens to global supply and demand? The lower oil prices go, and the longer they stay there, the less investment flows in, supply contracts, marginal producers shut down, and demand actually increases because cheap oil stimulates consumption. It's a self-correcting mechanism that's worked for a century. While everyone's focused on EVs and renewables, here's what's actually happening. Global population races towards 9.7 billion by 2050, adding 1.5 billion people, mostly in non-OECD nations. Africa alone will add 11.5 million barrels of oil equivalent per a day by 2050. India's oil demand will rocket from 5.5 to 13.7 million barrels per day by 2050. That's 8.2 million barrels of new demand from one country. Southeast Asia adds another 980,000 barrels by 2030. Africa adds 900,000. The petrochemical sector, plastics, fertilizers, chemicals, doubles to 18 million barrels per day by 2050. That's 75% of oil demand growth. Naphtha demand of 2.7 million barrels per day, LPG and ethane up to 3.6 million. OPEC projects oil will still represent 30% of total global energy consumption in 2050, with overall demand hitting 123 million barrels per day, up nearly 20 million from today. Trump's reshoring policies will slash trade deficits by 18%, boost GDP 1 to 2%, and fuel energy-intensive manufacturing. Think steel plants, auto factories, chemical facilities, all requiring petroleum products for production and transportation. Here's something critical. The EIA, everyone trusts, they underestimated U.S. shale production by up to 30% for 7 consecutive years from 2012 to 2019. Their forecasts consistently missed actual production by millions of barrels, yet markets still treat their current $52 prediction as the gospel. Now, let me share how we're positioned at Kingdom Exploration. While everyone's pouring capital into American shale, which needs $70 to $80 per barrel to break even, we are developing conventional oil projects during low-price environment. Here's the strategic advantage. When oil prices are low, development costs drop significantly. Drilling rigs, service equipment, everything becomes more economical. We're locking in projects at today's depressed cost that will generate returns at current prices with massive upside when the market turns. And here's the remarkable part. There's no investment that offers better tax benefits, where else can you invest and get 100% tax write-off for every dollar you put in while still making profits? The government allows you to write off 100% of qualified oil and gas investments. It's like giving to a charity, except you are building wealth. This extraordinary incentive is designed to boost American energy independence. We're focused on conventional wells that cost a fraction of shale operations, but produce steadily for decades. Quick disclaimer, all investments carry risk, and past performance don't guarantee future results. Consult your tax advisor about your specific situation. George Santayana warned that those who cannot remember the past are condemned to repeat it. In oil markets, this isn't a warning, it's an opportunity. Every single time we've seen this setup, analysts predict permanent oversupply, prices crater, pessimism peaks, then geopolitical events or demand surprises flip the script. Oil surges 100 to 700%. These skeptics always use the same language: drowning in oil, glut we can't fix, lower for longer, the party's over. They focus on current oversupply while ignoring the sparks that ignite rallies. The bearish consensus calling for $52 oil, Russian refineries under sustained drone attack, Venezuelan tensions that could disrupt Hormuz population growth driving unstoppable demand, petrochemical demand doubling, Trump policies supercharging U.S. industrial growth, an $18.2 trillion investment gap that must be filled, and government shutdown that's delaying but not stopping these forces. If even one of these factors accelerates, a Hormuz disruption, wider Ukraine conflict, faster emerging market growth, we flip from surplus to shortage overnight. History shows when that happens, prices don't rise gradually, they explode. Houthi Red Sea disruptions are already adding 3 to 5% premiums. Venezuelan supply could vanish. Any Middle East escalation sends prices vertical. We're talking potentially 50 to 100% surges, possibly more. This information challenges the mainstream narrative, which is why you won't hear it on financial news networks. The algorithm tends to suppress content that goes against conventional wisdom. If you found this analysis valuable, please share it, comment with your thoughts on these patterns. Subscribe if you want updates as this situation develops, because when oil markets turn, they turn fast. Remember, the greatest opportunities often come when consensus is most bearish. History doesn't just rhyme in oil markets. It practically photocopies itself. This is Sean Pruitt from Kingdom Exploration. Thank you for your time, and stay vigilant. The next chapter in oil's eternal cycle is about to be written.